Welcome to the Deep Dive. Really glad you could join us today. We're about to unpack a financial tool that could really make a difference in your retirement savings. Today, our deep dive is all about the Roth IRA. We'll look at its unique benefits, how it's different from traditional accounts, and why it's seen as such a powerful thing for your financial future. Our mission, basically, is to boil down the essentials on Roth IRAs, make the complex tax stuff, well, hopefully more accessible, and give you those aha moments so you feel really informed. Okay, before we properly dive in, just a quick reminder, this deep dive uses material from Farhat lectures. All the content, the examples, the explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, do check out the website. They've got loads of practice questions, video lectures, detailed support. Really good stuff to reinforce what we talk about today. And a special thanks to Professor Farhat for providing all this valuable material. Okay, let's get into it. Most people, they've heard of an IRA, right?
An individual retirement arrangement. But what makes a Roth IRA specifically? A Roth, it's actually named after Senator William Roth from Delaware. He championed the idea. But here's the big question, the core thing really. If a traditional IRA gives you a tax deduction now on your contributions today, why would anyone pick a Roth IRA? Where the contributions aren't deductible. What's the hidden strategy there?
That really is the central puzzle, isn't it? And it all boils down to when you actually get the tax benefit. Let's look at that fundamental difference in tax treatment for contributions. With a traditional IRA, your contributions are deductible. This means you lower your taxable income in the year you put the money in. So for example, say you put in the max for this year, $6,500, and maybe your tax rate is, say, 30%. Well, that immediately saves you $1,950, $1,950 in taxes today. That's a clear upfront saving. You feel that straight away.
Okay, that's pretty straightforward. Immediate benefit.
Right. Now, contrast that with the Roth IRA. Your contributions are non-deductible. So you put that same $6,500 in, you get $0 in deductions today. No upfront tax break at all. And that's exactly why people sometimes pause and wonder, why bother? Now, as for contribution limits, they're generally the same for both. $6,500 for individuals, or $13,000 for what's called a spousal IRA.
That's for a non-working spouse.
Exactly, if their partner has earned income. And importantly, you need to have earned income yourself, what they call individual compensation, to contribute. At least 100% of what you put in. Oh, and a helpful tip. Just like the traditional, there's an extended deadline. For a 2023 contribution, you actually have until April 15th, 2024 to make it.
Okay, so no immediate tax deduction. That still feels a bit backwards on the surface. But this must be where the Roth really starts to shine, right? What's the big payoff down the road that makes it so attractive?
This is it. This is the core benefit, the reason for the Roth IRA. Qualified distributions from a Roth IRA are completely 100% tax-free. Just think about that. You pay zero tax on the money you originally put in because, well, you already paid tax on it when you earned it. Makes sense. But here's the kicker. You also pay no taxes whatsoever on any of the earnings your money generated inside the Roth, no matter how much it grows over the years.
Wow, okay. No tax on the growth.
None. Now, compare that directly to the traditional IRA. Yes, you got that deduction up front, which felt good. But when you take money out in retirement, everything, your original contributions and all those earnings, is fully taxable as ordinary income.
Ah, okay. So the Roth flips it.
Exactly. It flips the tax benefit from today to the future. It's a strategic bet, really. Are you better off paying tax now on the seed or later on the whole harvest?
So thinking about someone planning for their future, maybe decades away, what does that mean practically? How do you make sure your withdrawal is qualified? How do you lock in that amazing tax-free benefit?
That's absolutely key. And the IRS has pretty strict rules. You need to meet two conditions at the same time. First, the account has to have been open and funded for at least 5 years. That's often called the 5-year rule. It's a hard requirement.
5 years. Got it.
And second, one of the following things must apply to the specific withdrawal you're making. Either you're age 59 and a half or older, or the money is going to a beneficiary or your estate after you pass away, or you've become permanently disabled, or the withdrawal is for qualified first-time homebuyer expenses, though there's a lifetime limit on that one, $10,000.
Okay, so 5 years plus one of those conditions.
Correct. Meet both, and the money comes out completely tax-free, earnings and all.
Right. But what if you take money out early? Say you don't meet those conditions. Is it all tax then?
Good question. What happens with non-qualified distributions? Well, it's not quite as bad as you might think initially. The withdrawals are first treated as a return of your original contributions, the money you already paid tax on. So that part comes out tax-free.
Ah, okay, so you get your own money back first, tax-free.
Exactly. Only after you've taken out all of your original contributions does any further distribution, which would then represent the earnings, become taxable and potentially subject to a penalty if you're under 59 and a half. It really shows why understanding these rules is so important to, avoid surprises and really get the most out of the Roth.
Let's make this more concrete. Our sources have a great example. Let's talk about Adam. This should give us a real aha moment about the power we're talking about. So here's Adam's situation. He opens a Roth IRA at age 40. And he's diligent. He contributes $5,000 every single year for 20 years. So his total contributions add up to $100,000. Make sense?
Yep.
5K times 20 years. But over those 2 decades, his investments did well. The account grew significantly, reaching a total value of $162,400, which means he had $62,400 in pure earnings.
Right. And the outcome for Adam, it's pretty impressive. By the time he hits 59 and a half, he's obviously met the 5-year holding rule easily. So he is eligible to withdraw the entire amount, the full $162,400, completely tax-free.
The whole thing, including the $62,400 profit.
The whole thing. 0 tax owed on that $62,400 in earnings. Now, let's put a number on that saving. If Adam's tax rate in retirement was, say, 30%, he saved $18,720 in taxes just on those earnings. $62,400 times 0.30.
18 grand saved. Wow.
That's money straight into his pocket instead of going to the government. Now, let's do that crucial comparison. What if Adam had used a traditional IRA instead? Okay, with a traditional, he would have gotten tax deductions on that $100,000 he put in over the years. Let's estimate his average tax rate back then was maybe 25%. So he would have saved about $25,000 in taxes up front over those 20 years, which sounds good.
Yeah, 25K savings now versus 18K later seems better up front.
But wait, here's the critical difference. Upon withdrawal from that traditional IRA, the entire balance, all $162,400, would be taxable income. If his tax rate in retirement is 30%, that means a tax bill of $48,720. $162,400 times 0.30.
Ouch. $48,000 in taxes versus 0.
Exactly. So while the traditional gave him $25,000 in savings earlier, the Roth saved him nearly $49,000 in taxes later. A much bigger win overall in Adam's case.
So looking at Adam, it just hammers home that long-term potential of tax-free growth, especially if your earnings are substantial. That $62,400 or maybe even way more stays yours. That's clearly a huge plus for the Roth. But thinking about that comparison, are there times when the traditional IRA is actually the better choice, despite Adam's win?
That's a really important point. Yes, absolutely. Adam's story is powerful, but the traditional IRA can definitely be the smarter move if you expect your income, and therefore your tax bracket, to be significantly lower in retirement than it is during your working years.
Okay.
If you're in a high tax bracket now, that upfront deduction is very valuable. And if you'll be in a much lower bracket later, paying tax on the withdrawals then might actually cost you less overall than paying the tax now at your current high rate.
So it's really about forecasting your future tax situation.
Precisely. It's a calculated guess about whether your tax rate will go up or down. And what's really interesting here, the benefits of the Roth, they actually go beyond just those tax-free retirement withdrawals. There are a couple of other, you might call them hidden advantages, that offer a lot of flexibility and are really key for long-term planning.
Oh, like what?
Okay, first big one. No required minimum distributions or RMDs at age 72.
RMDs. Right, that's where the government makes you start taking money out of traditional accounts.
Exactly. With traditional IRAs, 401k, once you hit age 72, you have to start withdrawing a certain amount each year, whether you need the money or not. And those withdrawals are taxed. But with a Roth IRA, nope. The government doesn't force you to take anything out ever.
Really? So you can just leave it in there?
You can leave it in there to keep growing tax-free for your entire lifetime if you want. You only take money out if and when you need it. It gives you incredible control and flexibility.
That sounds like a huge planning advantage.
It is, especially for estate planning, which brings me to the second point, tax-free inheritance. When you pass away, your Roth IRA can be passed directly to your beneficiaries, and guess what? They inherit it completely tax-free.
Wow. So the kids or grandkids don't get hit with a big tax bill.
Correct. Unlike inheriting a traditional IRA, where the beneficiaries usually have to pay income tax on the withdrawals, the Roth passes on as tax-free wealth. It's a major reason why some people prioritize funding their Roth and try to live off other assets they specifically want to leave that tax-free pot of money to their heirs.
Okay. Tax-free growth, tax-free withdrawals, no RMDs, tax-free inheritance. This Roth IRA sounds almost too good to be true. There has to be a catch, right? Congress isn't that generous, surely. Are there limits?
You're right. There's always a catch. The generosity does have limits, specifically based on your income. Not everyone can contribute the full amount, or sometimes anything at all, to a Roth IRA. There are adjusted gross income AGI phase-out rules.
AGI phase-outs. Okay, how do those work?
So for single filers, your ability to contribute starts getting reduced phasing out once your AGI hits $138,000, and it disappears completely once your AGI reaches $153,000. That's a $15,000 income range.
138K to 153K for singles.
Okay.
What about married couples?
For married filing jointly, the range is higher. The phase-out starts at $218,000 AGI and ends at $228,000 AGI. That's a tighter $10,000 range. And for married filing separately, the rules are much stricter. The phase-out is very low, just $0 to $10,000 AGI, so it's very difficult to contribute if you file separately.
Right, that's a tiny window. But let's use another example to make this phase-out thing clearer. What about Noah?
Okay, good idea. Let's look at Noah. He's single, it's 2023, and his adjusted gross income, his AGI, is $150,000. He wants to put the full $6,500 into his Roth IRA for the year.
Okay, 150K AGI. Where does that put him in the single range?
Well, the single range is $138,000 to $153,000, so his $150K is definitely inside that phase-out zone.
Right in the middle, almost.
Pretty much. He's $12,000 into that $15,000 range.
All right.
$150,000 minus $138,000. So we figure out what percentage of the way through the range he is. $12,000 divided by the total range width of $15,000. That's 0.80 or 80%.
Okay, 80%. What does that mean for his contribution?
It means that 80% of his maximum possible contribution, $6,500, is disallowed or phased out. So 80% of $6,500 is $5,200. He cannot contribute that $5,200 to a Roth IRA.
So he can only contribute the remaining 20%.
Exactly. The remaining 20%, which is $1,300, $6,500 minus $5,200. That's his maximum Roth IRA contribution for the year because of his income.
Wow, so his income significantly limited his Roth contribution. What happens to that other $5,200 he wanted to save? Is it just lost as a retirement contribution opportunity?
No, definitely not lost. He still has a good option for that $5,200. Well, he can't put it in the Roth. He can contribute it as an after-tax contribution to a traditional IRA, sometimes called a non-deductible IRA contribution.
Okay, an after-tax traditional contribution, how does that work tax-wise?
Well, the $5,200 itself isn't deductible, obviously, since it's after-tax money. But the advantage is that the money will grow tax-deferred inside the traditional IRA. The key difference compared to the Roth is what happens at withdrawal. When Noah eventually takes money out, that original $5,200 principal comes back out tax-free because he already paid tax on it.
Right, like the Roth contributions.
Yes. But unlike the Roth, the earnings on that $5,200 will be taxable upon withdrawal.
Ah, okay, so the earnings are taxed, whereas in the Roth, the earnings are tax-free.
Precisely. It still offers a tax advantage compared to, say, a regular taxable brokerage account because the growth isn't taxed year after year. But it really underscores why getting those earnings tax-free in a Roth is so valuable if you can qualify. It's that classic tax timing decision again, isn't it? Pay tax now for tax-free later, or get a potential benefit now but face taxes on growth down the line. So if we tie all this together, think about the big picture. The really crucial takeaway is that the timing when you choose to pay your taxes, now or later, fundamentally shapes the long-term tax outcome of your retirement savings. It's a strategic choice with potentially huge financial consequences.
Yeah, that really brings it home. And it leads to a key question for you, the listener, doesn't it? Looking at your own situation, current income, your career path, your future expectations, where do you think your tax rate will likely be higher? Is it today, during your peak earning years, perhaps? Or will it be in retirement, when maybe your income is lower, or maybe not? Answering that question for yourself is fundamental to figuring out if a Roth makes sense for you. That flexibility, that strategic element is what makes the Roth IRA such a powerful tool for so many people. It's not just about putting money aside. It's really about actively managing your long-term tax burden to keep more of what you've earned. So as we wrap up this deep dive, it's pretty clear, I think, that getting your head around the specifics of a Roth IRA really gives you a big strategic advantage in planning your financial future. It's about understanding how your savings grow and, crucially, how much you actually get to keep and use in the end. We really hope this exploration of the Roth IRA has given you some valuable insights and plenty to think about.
Keep learning, keep exploring those financial options, and we'll see you on the next deep dive.